Hello everyone, I am Mrs. K. Punitha, Assistant Professor, Department of Commerce, St.Josephs College of Arts and Science for Women, Huzur. Now I am going to discuss about the topic Marine Insurance. Introduction of Marine Insurance. When these goods are transported from one country to another country by ship, the ship exposed to obtained hazards due to marine perils such as cyclone, storm, collision of one ship against another rocks, etc. Burning, sinking of the ship, destruction of ship, cargo by the master of the ship or crew, war, pearls, pirates, robbers, thieves, captures, restraints and determinants of princes and people, jettisons, etc. The term originated when parties began to ship goods via sea. Despite what the name implies, marine insurance applies to all modes of transportation of goods. For instance, when goods are shipped by air, the insurance is known as the contract of marine cargo insurance. The marine insurance refers to the contract of indemnity. It is an assurance that the goods dispatched from one country to origin to the land of destination are insured. Marine insurance covers the loss, damage of ship, cargo, terminals and includes any other means of transport by which goods are transferred, acquired or held between points of origin and the final destination. Meaning and definition of marine insurance. Meaning, marine insurance has been defined as a contract between insurer and insured whereby the insurer undertakes to indemnity the insured in the manner and to interest thereby agreed against marine losses incident to marine adventure. Definition. Section 2 subsection 13a of the Insurance Act 1938 defines marine insurance as follows. Marine insurance business means the business of effecting contract the insurance upon vessels of any description including cargoes, freights and other interests which may be legally insured in relation such vessels, cargo and freights, goods, wares, merchandise and property of whatever descriptions insured by any transit by land or water or both. The weather are not including warehouse risk or similar risk in addition are the incidental to such transit and includes any other risk customarily include among the risks insured against in the marine insurance policies. Marine Insurance Act 1963. The Marine Insurance Act in India came into existence in 1963. As per Section 3 of the Act, any time to term marine insurance is used, expressed or even extended for the insuring of goods against loss or damage. The insured will be at risk to bear the charges. The insured will consider all the certainty of goods in case of misfortune sustained during marine ventures. Next one is characteristics of marine insurance. It is a contract of indemnity. It is a contract based upon the utmost good faith. Doctrine of subrogation and contribution apply. A marine policy is invariably subject to average class. All marine insurance contracts are subject to certain express and implied warranties. Contract of indemnity. The insurance extended to the parties will only be applicable up to the loss. The parties cannot buy the insurance to gain profits. If they do, they won't get more than the actual loss. Principles of good faith. Parties demand absolute trust on the part of the both the insurer and the guaranteed. Next, contribution. Sometimes the risk coverage for goods has more than one insurer. In such cases, the amount has to be fairly distributed among the insurers. Next, proximate cost. The proximate cost is not adjusted in time. Also, it is inefficient. Nevertheless, it is the definite and adequate cause of loss. Next, essential elements of marine insurance. The marine insurance has the following essential features which are also called fundamental principles of marine insurance. Fundamental features of general contract: insurable interest to exit at the time of loss, utmost good faith, contract of indemnity, subject to principles of subrogation and contribution, warranty, proximate cost, assignment and termination of policy, return on premium. These are elements is more or less same of the characteristics of marine insurance. Next, functions of marine insurance. First one is selection of company, selection of agent or broker, examine the marine declaration form, assessment of the risk, payment of premium, issues of cover note, issues of policy. Next, kinds of marine insurance policy. First one is time policy, voyage policy, mixed policy, valued policy, unvalued policy, floating policy, blanket policy, named policy, currency policy, PPI policy, port risk policy. Now detailed explanation in the policy terms. Time policy. Time policy in marine insurance is generally issued for a year's period. One can issue for more than a year. They may extend to complete a specific voyage, but it is normally for fixed period. Also under marine insurance in India, time policy can be issued only once a year. Next, voyage policy. A specific policy can be taken for the single lot or consignment only. The exporter needs to purchase insurance cover entry time to shipment or sent overseas. The drawback is the extra effort and time is involved each time on exporter sends consignment. With open policies, on the other hand, shipments are issued automatically. Mixed policy. Mixed policy is a mixture of two policies, that means voyage policy and time policy. Next one is floating policy. Floating in marine insurance policy, large exporters may opt for an open policy, also known as blanket policy, instead of taking insurance separately for each shipment. An open policy is one-time insurance that provides insurance cover against all shipments made during agreed period. Often a year, the exporter may need to declare periodically the detail of all shipments made during the period, type of goods, modes of transport, destination, etc. Named policy. Named policy is one of the most popular policy in marine insurance policy. The name of the ship is mentioned in the insurance document stating the policy issued in the name of the ship. Port risk policy. It is policy taken to ensure safety of the ship when it is sanctioned in a port. Blanket policy. In this policy, the owner has to pay the maximum protection amount at the time of buying the policy. Next, major types of marine insurance. First one is freight insurance, liability insurance, hull insurance, marine cargo insurance. Freight insurance refers, for example, if the goods are damaged in transit, the operator would lose freight receivables and so insurance will be provided on compensation for loss of a freight. Liability insurance. Marine liability insurance is where compensation is bought to provide any liability occurring on account of ship crashing or colliding. Hull insurance. Hull insurance covers hull torso of the transportation vehicle. It covers the transportation against damage and accidents. Marine cargo insurance. Marine cargo policy refers to the insurance of goods dispatched from one country of origin to the country of destination. These are all the types of marine insurance. Finally, you have an assessment. First heading is voyage and time policy. Explain the key difference between voyage and time marine insurance policies and discuss scenarios where each type might be more suitable for a particular marine risk. Next, general average. Define the concept of general average in marine insurance and provide examples of situations where general average loss may occur. Explain how the costs are approximate among the parties involved in the marine adventure. Kindly give your answer in the comment box. Thank you.